Before we get started, it is crucial to understand that the information presented in this video is for educational and informational purposes only. It is not intended as and should not be taken as financial, legal, or real estate advice. I am not your financial advisor. The world of mortgages and real estate is complex and highly specific to your individual circumstances, local laws, and market conditions. This presentation is designed to give you a powerful framework for understanding the topic, but it is not a substitute for professional guidance. Please always consult with a qualified financial advisor, a mortgage broker, and a real estate attorney in your state before making any decisions that could impact your financial future. Our goal here is to arm you with knowledge, so you can ask the right questions and have more intelligent conversations with the experts you hire. Imagine this for a second. You found it. The perfect house. Not just a house, but the house. It's got the big backyard you've always wanted for your dog, the open concept kitchen where you can already picture holiday dinners, and it's in that one neighborhood you thought you could never afford. You've saved for years, you've sacrificed, you've done everything right. You fill out the mortgage application, your hands literally shaking with a mix of excitement and nerves. You hit submit, and then you wait. A few days later, the email lands in your inbox. You hold your breath, click it open, and there they are. The words that feel like a punch to the gut. We regret to inform you that your application has been denied. Your credit score was just a few points too low. Or maybe your debt-to-income ratio was a hair over their limit because of those student loans. Or perhaps you're a freelancer, and your income history isn't the clean 2-year W-2 history the banks drool over. The dream evaporates. It feels like you've hit a brick wall at 100 miles an hour. But what if I told you there's a secret door in that wall? A financial skeleton key that millions of Americans have used to unlock the home of their dreams when the bank first said no. It's called a mortgage guarantor. And leveraging one could be the single smartest financial decision you ever make. Or it could be a catastrophic mistake that not only ruins you financially, but also destroys your most important relationships forever. That's why you're here. In this video, we are going to pull back the curtain on one of the most powerful, yet most misunderstood tools in American real estate. We are going to give you a complete roadmap to the world of mortgage guarantors. By the time you're done watching, you will know exactly what a guarantor is, why a bank would even consider one, and most importantly, you'll understand the life-changing pros and the devastating cons that come with asking someone to back your mortgage. This isn't just information. This is a shield to protect you from making a multi-$100,000 mistake. So let's start at the beginning. What on earth is a mortgage guarantor? The simplest way to think about it is this. A guarantor is a financial safety net for the bank. They are someone, typically a parent, a close relative, or a very trusted friend, who says to the lender, "Hey, I believe in this person. I trust them to make their payments, but if for some reason they can't, I will." The guarantor doesn't pay the mortgage every month. They don't own the property. Their name isn't on the title. They are, in essence, a silent partner in the background, whose only job is to step in if the primary borrower defaults on the loan. They are the bank's plan B. They are the reason a lender is willing to take a risk on you when your application on its own looks a little shaky. Now, why would you even need one? Well, the reasons are the exact heartbreaks we talked about a minute ago. The first and most common reason is a borderline credit score. Maybe you're young and haven't had time to build a robust credit history, or you hit a rough patch a few years ago that's still haunting your credit report. To a bank, a low score screams risk. A guarantor with a stellar credit history basically vouches for you, telling the bank, "My great credit history backs their promise." The second big reason is your debt-to-income ratio, or DTI. This is a huge one. Your DTI is the percentage of your gross monthly income that goes toward paying your monthly debt payments. Lenders have very strict limits on this. If your student loans, car payments, and credit card bills push you over that limit, you'll get an automatic denial even with a great income and perfect credit. A guarantor with a low DTI and high income can offset your numbers, making your application look much stronger to the underwriters. A third common scenario is an unconventional employment history. Welcome to the gig economy. If you're a freelancer, a contractor, or you just started a new business, you might not have the 2 years of consistent, verifiable W-2 income that banks love to see. Even if you're making great money, your fluctuating income can make lenders nervous. A guarantor with a long, stable employment history provides the security the bank needs to see past your non-traditional career path. And finally, you might need a guarantor simply to qualify for a larger loan. In today's high-priced housing market, the loan you can get approved for on your own might not be enough to buy a decent home in your area. Adding the financial strength of a guarantor can significantly increase your borrowing power, opening up a whole new tier of properties that were previously out of reach. Now, here is where most people get tripped up, and this one point is worth the price of admission. A guarantor is not the same thing as a cosigner or a co-borrower. These terms are often used interchangeably, but they are legally and financially worlds apart, and confusing them can lead to disaster. Let's break it down. A co-borrower is a co-owner. Think of a married couple buying a house together. Both names are on the mortgage application, and both names are on the title to the property. They share ownership, they share the debt, they share everything. Simple enough. Cosigner is a bit different. A cosigner is also on the loan and is equally responsible for the debt from day one. If a payment is 30 days late, it hits both the primary borrowers and the cosigner's credit report immediately. The bank sees them as one and the same. While the cosigner isn't typically on the property title, they are on the hook for every single payment on time right alongside the main borrower. A guarantor, however, is a step removed. They are providing a guarantee of payment, not an obligation for the day-to-day payments. Their legal obligation only kicks in after the primary borrower has officially defaulted on the loan, meaning they've missed several payments and ignored the bank's warnings. Only then can the lender turn to the guarantor and say, "Okay, your person failed. It's your turn to pay." This distinction is subtle but absolutely massive. It makes the guarantor a backstop, not a frontline player. So, on the surface, this sounds amazing, right? It's a golden ticket. It's the loophole that gets you into your dream home when the front door is locked. Can mean getting approved when you otherwise wouldn't. It can mean securing a much lower interest rate, saving you tens of thousands of dollars over the life of the loan. And it can mean getting into the housing market years sooner than you could on your own, allowing you to start building equity and wealth while your peers are still stuck renting. These are the incredible life-altering pros of having a guarantor. But there is a dark side, a very dark side. For every story of a guarantor helping someone achieve the American dream, there's a horror story lurking in the shadows. A story of a parent losing their retirement savings. A story of a lifelong friendship shattered over a missed payment. A story of hidden clauses in the fine print that trap the guarantor in a financial nightmare for decades, with no way out. The risks are not just financial. They are deeply personal and can be emotionally devastating. Stepping into the role of a guarantor, or asking someone to do it for you, is like walking through a minefield. One wrong step, one bit of overlooked fine print, one unexpected life event like a job loss or medical emergency, and everything can explode. So, how do you navigate this minefield? How do you tap into the incredible power of a guarantor to secure your dream home, without blowing up your finances and your most important relationships in the process? That is the critical question we are going to answer. We're about to dissect the specific, tangible benefits you can gain, and then we'll shine a bright light on every single risk you and your guarantor will face, so you can walk into this with your eyes wide open. Let's start with the most significant, most immediate benefit, simply getting your foot in the door. For so many aspiring homeowners, the biggest wall they hit is the lender's cold, hard math. And the cornerstone of that math is something called the debt-to-income ratio, or DTI. Think of it like this. A lender looks at how much money you make each month before taxes. Then they look at all your fixed monthly debt payments, your car loan, your student loans, your credit card minimums. They divide your debt by your income. And if that number is too high, it's an automatic red flag. To them, it looks like you're already struggling to stay afloat, and adding a massive mortgage payment would be like handing you an anchor. Now imagine a young graphic designer. Let's call her Amanda. She makes a solid $65,000 a year. She's responsible, she's saved a bit, but she also has a hefty student loan payment from art school. She finds a perfect little starter condo for $250,000. She runs the numbers, and the mortgage, taxes, and insurance would be about $1,800 a month. She can afford that. She's been paying more than that in rent for years. But when she goes to the bank, they add that potential $1,800 to her $600 student loan payment and her $300 car payment. Suddenly, her monthly debt is $2,700. Her gross monthly income is about $5,400. The bank does the division, and her DTI comes out to 50%. The lender's absolute maximum is 45%. The computer says no. End of story. Amanda is crushed. The dream is dead before it even began. This is where the guarantor steps in like a superhero for spreadsheets. Let's say Amanda's father, a retired engineer with a great pension and no debt, agrees to be her guarantor. The bank now doesn't just look at Amanda's $5,400 a month. They add her father's income to the equation. His stable, predictable income completely changes the calculation. The denominator in that DTI fraction just got way bigger. Now, even with her debt, the combined income makes the ratio look incredibly safe. It plummets from a scary 50% down to a comfortable 25%. The lender's red flag turns into a green light. The computer says yes. Amanda gets the loan. Her father's financial strength didn't give her a single dollar in cash, but it provided the one thing she couldn't get on her own: the bank's confidence. He acted as a powerful financial backstop, telling the lender, "Don't worry, even if she stumbles, this mortgage will be paid. I guarantee it." That guarantee is often the only key that can unlock the door to homeownership. But what if your income is fine, and it's your past that's haunting you? This brings us to the second huge pro: overcoming a damaged or thin credit history. Your credit score is your financial report card. It tells lenders the story of how you've handled debt in the past. Maybe you hit a rough patch a few years ago. A medical emergency, a sudden job loss, life happens. You missed a few payments and your score took a nosedive. Now, you're back on your feet, you're paying everything on time, but that score is still recovering. It's like a shadow that follows you. To a lender, a low score, say anything below a 640, screams risk. They don't see the person who has worked hard to recover. They see a statistical probability of default. Let's consider Ben. Ben had a nasty car accident 3 years ago that put him out of work for 6 months. He fell behind on his credit cards to cover his bills. He's since paid everything off and has been a model of financial responsibility, but his credit score is still stuck at 620. He's got a great job in IT, a solid income, but every lender he talks to either flat out rejects him or offers him a mortgage with an absolutely predatory interest rate. They're punishing him for a crisis that happened years ago. Now his older sister, Chloe, who has an impeccable 810 credit score, agrees to be his guarantor. This is a game changer. The lender is no longer just underwriting Ben and his shaky past. They are now underwriting Chloe and her pristine 2-decade-long history of perfect payments. Her stellar credit score acts as a powerful endorsement. It's like having the most trusted person in town vouch for you. The lender's risk assessment shifts dramatically. They're thinking, well, Ben might be a bit of a risk, but Chloe is a sure thing. The likelihood of both of them failing to make the payment is astronomically low. Suddenly, Ben isn't just approved. He's approved for a loan with a reasonable, competitive interest rate. Chloe's creditworthiness didn't just open the door for him. It saved him from being taken advantage of with a subprime loan that could have cost him tens of thousands of extra dollars over the years. Speaking of saving money, let's talk about the third major advantage: a better shot at a lower down payment and avoiding that dreaded acronym PMI. Private mortgage insurance. PMI is not insurance for you. It's insurance that you are forced to pay for, to protect the lender in case you default. Lenders typically require it if you put down less than 20% of the home's purchase price. And it's not cheap. It can add hundreds of dollars to your monthly mortgage payment for years without building you a single cent of equity. It's like burning money every single month. The problem is, saving up a 20% down payment is a monumental task for most Americans. On a $300,000 house, that's $60,000 in cash. For many, that's an impossible goal. While a guarantor doesn't just hand you the down payment, their financial strength can make a lender far more comfortable with you putting down less. A lender might have a special loan program that only requires 5% down, but they'll only offer it to the most qualified, low-risk applicants. On your own, with your borderline DTI or your recovering credit score, you wouldn't even be considered for that program. You'd be pushed towards a loan that requires a higher down payment or one that comes with a punishingly high PMI premium. But with your guarantor co-signing, you suddenly look like one of those top-tier applicants. Their strong income and pristine credit elevate your entire application. The bank is more willing to offer you their best products, including those low down payment options. So, instead of needing $60,000, you might only need $15,000. And because the lender feels so much more secure thanks to your guarantor, you might qualify for a loan with a reduced PMI rate, or in some cases, a structure that avoids it altogether. This doesn't just help you get the house. It makes the house more affordable month after month, freeing up hundreds of dollars that can go towards savings, investments, or actually enjoying your new home, instead of just paying for the bank's insurance policy. Finally, let's tie all of this together into the fourth, and perhaps most underrated pro: securing a lower interest rate. We often focus so much on just getting approved that we forget how critical the interest rate is. A seemingly small difference can have a staggering impact over the life of a 30-year loan. Let's say on a $400,000 mortgage, you qualify on your own for a 7% interest rate. But with your guarantor, your application is so much stronger that the lender offers you a rate of 6.5%. 0.5%? It doesn't sound like much, right? Wrong. That 0.5% difference will save you over $150 every single month. Over the 30-year life of the loan, that adds up to more than $56,000 in saved interest payments. $56,000. That's a new car. That's a college fund. That's a life-changing amount of money saved, simply because your guarantor's financial strength made you a less risky bet in the eyes of the bank. So, when you look at the upside, it's incredibly compelling. A guarantor can be the difference between a rejection and an approval. They can help you overcome a bruised credit history, reduce your need for a massive down payment, and save you a fortune in interest. It paints a beautiful picture, doesn't it? The door to homeownership swings wide open, you get the keys to your dream home. And you do it on terms you can actually afford. Seems like a perfect win-win situation. But this is precisely where the dream can shatter. Because every single one of these benefits for you, the borrower, is built on a mountain of risk for the person you ask to help, your guarantor. This isn't just a simple favor. It's not like asking someone to help you move a couch. This is a profound, legally binding financial entanglement that can have devastating consequences. The very same pen that signs you into your dream home can sign your guarantor into a financial nightmare from which there is often no escape. And understanding the sheer gravity of that risk is not just important. It is the most critical part of this entire decision. Let's peel back the legal jargon and look at what that signature actually does to your guarantor's life, because it creates something I call a shadow mortgage. It's a debt they don't feel day to day, but it follows them everywhere, silently waiting in the darkness. The first and most misunderstood con for the guarantor is the legal principle that underpins the entire agreement, joint and several liability. Now that sounds like a boring law school term, but it is the financial equivalent of a loaded gun. It does not mean the bank will ask you for your half and the borrower for their half. It does not mean the bank will try their hardest to get the money from the borrower first, and only come to the guarantor as a last resort. No, it means the bank can legally demand 100% of the debt from either party at any time. And who do you think they will pursue? The person who is struggling to make payments, or the person with the stable job, the good credit, and the assets they put up to qualify in the first place? They will always choose the path of least resistance. The moment you miss a payment, your guarantor is no longer the backup plan. They are the plan. They are on the hook for the entire mortgage payment, every single month, plus any late fees that have piled up. The bank doesn't care about their personal relationship with you. They care about their bottom line. The guarantor is not a safety net for you. They are a primary target for the lender. But the damage starts long before the bank even makes a phone call. It begins with a quiet digital wound that can bleed for years. The impact on their credit score. When you sign as a guarantor, you are essentially splicing your financial DNA with the borrower's. Your credit report and theirs are now linked through this massive debt. So when the primary borrower is 30 days late on a payment, it's not just their credit that takes a hit. That late payment gets reported on the guarantor's credit report too. It appears as if they were the ones who were late. Think about that. Your kind, responsible parent who has spent 40 years building a perfect 820 FICO score by paying every bill on time, can see their score plummet by 60, 80, even over 100 points overnight because you had a tough month. A single mistake, a single late payment can undo decades of their financial discipline. And that scar doesn't just vanish when the payment is made. A late payment notation stays on a credit report for 7 years. 7 years of explaining to every future lender why there's a black mark on their otherwise spotless record. 7 years of higher interest rates on car loans, credit cards, and any other financing they might need, all because they did you a favor. This leads directly to the next devastating con, the debt-to-income ratio trap, or DTI. Your DTI is one of the most important numbers in your financial life. It's the percentage of your gross monthly income that goes toward paying your monthly debt obligations. Lenders use it to determine if you can afford to take on new debt. When your parent or friend signs as a guarantor on your $500,000 mortgage, that entire mortgage, the full monthly payment, is now factored into their debt-to-income ratio. Let me paint you a picture. Imagine your guarantor a few years down the line decides they want to sell their home and downsize for retirement. They find a perfect little condo, go to the bank for a small, manageable loan, and the loan officer gives them a sympathetic look and says, "I'm sorry, but we can't approve this. Your debt-to-income ratio is too high." Your guarantor would be confused. "That's impossible, my house is paid off, I have no car payments." And the loan officer will turn their screen around and point to a line item that says, $450,000 mortgage. And when your guarantor says, "Oh no, that's my child's house, I just co-signed to help them out," the banker will simply say, "To us, it's your debt." They are now trapped. The shadow mortgage has become a very real wall, blocking them from their own financial goals. They can't refinance their own home. They can't get a loan to start a small business. They might even be denied a new credit card. Their financial freedom has been sacrificed, held hostage by a debt that isn't even for a house they live in. And as terrible as all that sounds, we still haven't reached the worst-case scenario. What happens if you, the borrower, lose your job, suffer a medical emergency, or simply can't make the payments anymore and the loan goes into default? This is where the nightmare truly begins for the guarantor. The bank won't just ask them to cover a few payments. They will invoke something called an acceleration clause, which is standard in virtually every mortgage contract. This clause gives the lender the right to demand the entire outstanding loan balance be paid in full, immediately. We're not talking about a $3,000 monthly payment. We're talking about a demand for $300,000. $400,000. Right now. If the guarantor can't write a check for that amount, and almost nobody can, the bank will begin legal proceedings. They will sue the guarantor for the full amount of the loan. If the bank wins the lawsuit, which they almost always do, they get a judgment against the guarantor. This is a court order that gives them terrifying power. They can garnish the guarantor's wages, taking a chunk of their salary directly from their employer before they ever see it. They can levy their bank accounts, freezing and seizing every penny in their savings and checking. They can put a lien on their other assets, their own home, their car, their investment portfolio. They can force the sale of the guarantor's own property to satisfy your debt. The home they raised their family in, it could be sold at auction. The retirement nest egg they spent a lifetime building, could be wiped out in an instant. This is not a theoretical risk. It is a brutal, catastrophic reality that plays out in courtrooms across America every single day. And through all of this financial devastation, there is an even deeper, more personal cost: the destruction of the relationship. The very reason a guarantor agrees to this in the first place is almost always love, trust, and a desire to help. But money has a way of poisoning even the purest intentions. Think of the tension at Thanksgiving dinner when you're behind on the mortgage. Think of the phone calls that start with, "I'm sorry to ask, but," and end in a screaming match. The guarantor feels like a prisoner, their financial future chained to your choices. The borrower feels shame, guilt, and resentment for being constantly monitored. The dynamic shifts from parent and child to creditor and debtor. The trust that was the foundation of the agreement is systematically crushed under the weight of financial anxiety. Friendships of decades have ended over this. Families have been torn apart, sometimes irreparably. The love that made them sign the paper is often the very thing that is destroyed by it. Finally, perhaps the cruelest part of this whole arrangement is that it is incredibly difficult to escape. A guarantor can't just call the bank and say, "I've changed my mind." They can't just have their name taken off the loan. The bank has absolutely no incentive to release the financially stronger party from the agreement. There are typically only two ways out: sell the house and pay off the loan, or the primary borrower refinances the mortgage solely in their own name. But that creates the ultimate catch-22. If the borrower's financial situation had improved enough to qualify for a refinance on their own, they likely wouldn't have needed a guarantor in the first place. So the guarantor is often trapped for years, sometimes for the full 30-year term of the loan, living with that shadow mortgage hanging over every financial decision they make. So given this landscape of catastrophic financial risk, credit score annihilation, and the potential for emotional ruin, why in God's name would anyone ever agree to do this? Is it simply a case of financial illiteracy, or blind love overriding common sense? Or are there specific, calculated situations where taking this monumental gamble can actually be the right move? A move that unlocks the American dream not just for the borrower, but for the whole family? The answer to that is far more complicated and reveals a deep, often unspoken truth about wealth and opportunity in this country. That unspoken truth is this: in America, the starting line isn't the same for everyone. For generations, the single greatest accelerator of wealth has been property ownership. And the single greatest barrier to that ownership is often the initial approval. The moment a lender looks at your file and says, yes or no, a guarantor fundamentally changes that moment. They don't just put their name on a line. They effectively move the starting line for their loved one, catapulting them past obstacles that trap millions of others in the cycle of renting. Let's start with the most obvious and powerful advantage: blasting through the credit score barrier. Imagine a young professional. Let's call her Jessica. She's a graphic designer, making a solid $80,000 a year. She's responsible, she pays her bills, but her credit history is thin. She's only had a credit card for a few years, and her biggest debt is her student loans, which she's paying on time. But when she goes to a bank for a mortgage, the algorithm sees her thin file and her student loan balance and flags her as a risk. The loan officer might be sympathetic, but the numbers are the numbers. To the cold, hard system, she's a no. It's a frustrating, demoralizing experience that countless young Americans face. They're doing everything right, but the system, built on decades of data, isn't designed for their modern financial reality. Now enter her father, David. David has been a homeowner for 30 years. He has a credit score north of 800. He's got credit cards he's paid on time since the 1990s. His financial history is a rock. When David agrees to be a guarantor, the bank's entire calculation changes. They are no longer just lending to Jessica, the promising but unproven designer. They are lending to the combined strength of Jessica and David. David's pristine credit history acts as a powerful endorsement, a vouch of confidence that no letter of recommendation could ever match. His score doesn't just supplement Jessica's. It effectively overrides the system's caution. Suddenly, the loan officer isn't looking at a risk. They're looking at an opportunity backed by decades of proven financial responsibility. The no transforms into a yes. This is the first and perhaps most profound pro of having a guarantor. It's a key that unlocks a door that would have otherwise remained bolted shut. But it's not just about credit history. The second major advantage is conquering the dreaded debt-to-income ratio, or DTI. This is the silent killer of mortgage applications. Lenders calculate all of your monthly debt payments, student loans, car payments, credit card minimums, and divide it by your gross monthly income. If that percentage is too high, typically over 43 to 45%, you're out. Consider another scenario. A young couple, Mark and Sarah, living in a high-cost city like Denver or Austin. They both have good jobs in tech, bringing in a combined income of $150,000. Sounds great, right? But they also have significant student loan debt from their master's degrees and a car payment. When the bank runs their DTI, it comes in at 48%. They are just over the line. They can afford the monthly mortgage payment. In fact, it's less than the rent they're currently paying for a smaller apartment, but the bank's rules are rigid. They are trapped. This is where a guarantor becomes a game changer. When a guarantor with a strong income and low debt of their own steps in, some lenders will allow their income to be considered in the DTI calculation. This is huge. Suddenly, the denominator in that DTI equation gets a massive boost. The couple's debt stays the same, but the income side of the ledger swells with the guarantor's earnings. That 48% DTI plummets to a much more attractive 35%. The application goes from the rejection pile to the top of the approval stack. This isn't a loophole. It's a feature of the system designed for situations just like this. It's a recognition that the couple's financial picture, when viewed as part of a stronger, multi-generational family unit, is far less risky. It allows the lender to see the forest, not just the trees of student debt. Getting approved is one thing, but the quality of that approval is another. This brings us to the third and most financially impactful pro: securing a better interest rate and more favorable loan terms. The world of mortgages is all about risk. The riskier you appear to a lender, the higher the interest rate they'll charge you to compensate for that risk. Someone who barely qualifies on their own with a lower credit score and a high DTI might get approved, but they'll be slapped with a higher interest rate. A guarantor completely changes this dynamic. With a financially solid guarantor on the application, the perceived risk to the lender evaporates. The loan is now seen as a top-tier, low-risk investment for the bank. And what does that mean for the borrower? It means a lower interest rate. A significantly lower interest rate. You might think a small difference, say getting a 6.5% rate instead of a 7.25% rate, is no big deal. You would be wrong. On a $400,000 30-year mortgage, that 3/4 of a percentage point difference saves you over $200 every single month. Over the life of the loan, That adds up to more than $80,000 in saved interest payments. $80,000. That's a college fund. That's a full kitchen renovation. That's years of family vacations. A guarantor doesn't just help you get the keys to the house. They are, in effect, handing you a check for $80,000 in future savings. They are fundamentally altering your financial trajectory for the next 30 years, freeing up capital that you can use to invest, save, and build your own wealth even faster. This leads us to the final and most profound pro of all. It's the one that underpins everything we've talked about. Having a guarantor is one of the most direct and powerful mechanisms for intergenerational wealth transfer that exists in America today. We often think of inheritance as something that happens after someone is gone, a lump sum of money or property passed down. But that's a very narrow view. True wealth transfer is about transferring opportunity. It's about using the stability and security built by one generation to give the next generation a crucial head start. Homeownership isn't just about having a place to live. It's a forced savings account. It's an asset that, over time, appreciates in value. It's a source of equity you can borrow against for emergencies, for your children's education, or to start a business. By enabling a child or grandchild to buy a home years before they could have on their own, a guarantor is stopping the bleed of rent money that disappears every month into a landlord's pocket, and redirecting it into an asset that builds the borrower's own net worth. They are compressing time. A 5-year head start on homeownership could mean hundreds of thousands of dollars in additional net worth by the time they reach retirement. This is the unspoken truth we mentioned earlier. It's a form of private, familial support that operates outside of any government program. It's a legacy in motion. A parent or grandparent uses the equity and credit they spent a lifetime building to erect a financial bridge for their family, allowing them to cross over a chasm of financial barriers that would otherwise be impassable. It's a beautiful, powerful act of faith in the next generation. It's a story of family, of legacy, and of securing the American dream in the most tangible way possible. It sounds like a perfect solution, a flawless strategy with no downside. A heartwarming story of family coming together to build a better future. And in a perfect world, that's exactly what it is. But we don't live in a perfect world. What happens when the unexpected strikes? When the borrower loses their job? When a medical emergency drains their savings? When the housing market takes a sudden brutal downturn? What happens when the very relationship between the borrower and the guarantor, built on love and trust, begins to crack under the immense financial pressure? The same signature that built that bridge can also become an unbreakable chain, dragging an entire family's financial security down into the depths. And the legal and emotional fallout is something most families are completely and devastatingly unprepared for. So let's talk about the moment that chain begins to tighten. It doesn't start with a bang. It starts with a letter. A single innocuous-looking envelope that arrives in the guarantor's mailbox. It's from the lender. It's polite, formal, but the words inside are a gut punch. It's a notice of delinquency. It says the mortgage payment is 30 days late. This isn't a warning. It's an activation. That signature you provided years ago, full of hope and goodwill, it just woke up. And it's hungry. Your first reaction is confusion, then concern. You call your son, your daughter, whoever you co-signed for. Hey, I got a letter from the bank. Is everything okay? And that's when you hear the hesitation in their voice. The story comes out. A lost job, unexpected medical bills, a business venture that failed. They were too embarrassed, too ashamed to tell you. They thought they could fix it, that they could catch up before anyone noticed. But the bank always notices. And here is the first brutal misconception people have about being a guarantor. They think the bank will exhaust every option with the primary borrower before they come after you. They believe they are the lender's last resort, a final safety net. This is dangerously, catastrophically wrong. The legal term that governs this relationship is joint and several liability. It's a phrase you need to burn into your memory. It doesn't mean you're responsible for your part. It means you are each individually responsible for 100% of the debt. To the bank, you are not a backup plan. You are an alternate and often more attractive primary target. Why would they spend months chasing a borrower who has just lost their job and has no assets, when your name is right there on the loan document, attached to a healthy credit score, a stable income, and a home with $500,000 in equity? They won't. They will go after the path of least resistance. They will come for you. So after that first letter, the collection calls begin. They're not just calling the borrower anymore. They're calling you. At work. On your cell phone. In the evening, the tone is no longer polite. They want to know when they can expect payment. Not a partial payment, the full amount plus late fees. And when you try to explain that you're just the guarantor, they will calmly, professionally inform you that under the terms of the agreement you signed, you are just as liable as the person living in the house. As far as they're concerned, it's your debt now. Simultaneously, a financial bomb detonates on your credit report. It's not a small crack, it's a seismic event. That first 30-day late payment hits your FICO score like a torpedo. Your pristine 810 score, the one you spent 30 years building, meticulously paying every bill on time, could plummet 100 points. Instantly. A 60-day late notice follows and it drops again. 90 days? You are now in a completely different credit tier. The damage is catastrophic and it is immediate. Think about what that means. Your own financial life, which was perfectly in order, is now in shambles because of a decision you made out of love. You go to trade in your car, and the dealer offers you an interest rate of 19%. Your credit card company slashes your limit and jacks up your APR. You apply to refinance your own mortgage to take advantage of lower rates, and the bank laughs you out of the office. You are now considered a high-risk borrower, tainted by a default that wasn't even your own. The opportunities and financial flexibility you worked your entire life to secure? Gone. Vanished in 90 days. But it gets so much worse. If the payments don't resume, the lender moves to the next stage. They don't just want the missed payments anymore. They invoke the acceleration clause, a standard piece of terrifying fine print in most mortgage contracts. This clause states that if the borrower defaults, the entire remaining loan balance becomes due. Immediately, that $400,000 mortgage, they want it all. Now, from you. You receive a demand letter from the lender's attorneys for the full, outstanding balance. You have 30 days to pay. Of course, you don't have $400,000 in cash. Almost nobody does. And this is when the legal machinery of debt collection grinds into motion, aimed directly at your life. The lender will file a lawsuit, not just against the borrower but against you, the guarantor. Since you willingly signed the agreement, there is no defense. You are legally obligated to pay. The court will almost certainly grant a judgment in the bank's favor. This judgment is not just a piece of paper. It is a legal weapon. With that judgment in hand, the lender can now do things that will turn your world upside down. They can garnish your wages. That means they can get a court order to have your employer send a significant portion of every single paycheck you earn, up to 25% in many states, directly to them before you even see it. Imagine working 40 hours a week, but only taking home the pay for 30. They can levy your bank accounts. They can walk into your bank, armed with that court order, and the bank is legally required to freeze your accounts and hand over the money inside. Your checking account, your savings, your retirement fund that you were planning to live on. It can all be seized. And here's the ultimate nightmare scenario for a guarantor. They can place a lien on your assets, specifically on your own home. The home you live in, the one that's fully paid off, the cornerstone of your family's security. A lien means you can't sell it, you can't refinance it, you can't pass it on to your kids without paying the bank first. That home becomes collateral for someone else's broken promise. All the while, the emotional fallout is devastating. The relationship with your child is in tatters. Thanksgiving dinners are silent and suffocating. There's blame, shame, and resentment. They feel guilty for ruining your life. You feel betrayed and terrified about your future. The very act of love that was meant to build a bridge between generations has become a wrecking ball, smashing both of your financial houses to pieces. The bank forecloses on the property, and it's sold at auction. But even that might not be the end of it. If the house sells for less than the total amount owed, which is common in a forced sale, the bank can come after you for the difference. This is called a deficiency judgment. So even after the house is gone, you are still legally on the hook, potentially for tens or even hundreds of thousands of dollars. This is the unvarnished, brutal reality of what happens when a guarantee goes wrong. It's a complete and total assumption of risk with almost no direct reward. You put your entire financial past, present, and future on the line. So the question becomes, is there any way to mitigate this? Are there legal structures or specific contract clauses that can protect a guarantor from this kind of absolute ruin? Is it possible to be a safety net without strapping yourself to a financial suicide vest? The answer is nuanced, and it requires a level of legal and financial savvy that most families, unfortunately, never even know they need until it's far, far too late. So let's pull back the curtain on this exact moment. Imagine a kitchen table. On one side, you have parents who've worked their entire lives, built a nest egg, and are looking forward to a comfortable, quiet retirement. On the other side, you have their child, bright, ambitious, full of dreams, but shut out of the housing market by student debt, stagnant wages, and skyrocketing home prices. The conversation is emotional. It's about legacy, about opportunity, about giving the next generation a leg up. And then the ask comes, "Mom, Dad, would you be our guarantor?" In that moment, logic often leaves the room. This isn't a business transaction. It's a family obligation. It's an act of love. The parents see their child's future, a home, maybe future grandchildren playing in the yard. They don't see the hundreds of pages of dense legal jargon that will soon be placed in front of them. And this is the first and most critical mistake. The decision is made emotionally, but the consequences are brutally, legally, and financially real. When that stack of documents arrives from the lender, it's designed to be intimidating. It's filled with terms like indemnification, subrogation, and unconditional liability. The natural human tendency is to feel overwhelmed, to trust the loan officer who says, "Oh, this is all just standard stuff," and to just sign where the little yellow sticky flags tell you to. But standard stuff in the world of lending is written by the bank's lawyers, for the bank's protection, not yours. Hidden within that standard language are the very mechanisms that turn a safety net into a financial guillotine. Let's talk about the single most misunderstood phrase in any guarantor agreement: joint and several liability. It sounds innocuous, doesn't it? Joint sounds like you're in it together, sharing the load. Several sounds like you're each responsible for your separate parts. But in the language of law, it means the exact opposite. Joint and several liability means that the lender can demand the entire payment of the loan from any one of the signers. Let me repeat that, because it's the key that unlocks this entire trap. The bank does not have to split the responsibility. If your child misses a single payment, the bank doesn't have to chase them for their half. They have the full legal right to come directly to you, the guarantor, for 100% of the mortgage payment, 100% of the late fees, and if it goes into default, 100% of the outstanding loan balance. Think of it like this: you go out to dinner with 3 friends. You order a small salad, but your friends order lobster, steak, and expensive wine. The bill comes and it's huge. Joint and several liability is the equivalent of your friends all walking out, and the restaurant owner handing you the entire bill and saying, "You were at the table. You pay all of it." It's up to you to get the money back from your friends. That is precisely the power you hand a lender when you sign as a guarantor. You are not just promising to cover your child's missed payment. You are promising to become the primary borrower in the bank's eyes the second things go wrong. But it gets worse. The next landmine is the unconditional and absolute guarantee clause. This is legal speak for a promise with no escape hatches. An unconditional guarantee means you are on the hook no matter what. Let's say the bank made a mistake in the paperwork. Doesn't matter, you still have to pay. Let's say the bank decides to give your child a 6-month forbearance period without telling you, during which interest accrues like crazy. Doesn't matter, you're on the hook for that new higher balance. Let's say your child and their spouse get a divorce, and the house is part of a messy, contested legal battle. The bank doesn't care. They will turn to the one person from whom they can get a clean, simple payment: you. This clause strips you of nearly every defense you might think you have. It's the lender's way of saying, your signature is a blank check, and we reserve the right to cash it whenever we want, for whatever the full amount is, no questions asked. And to make sure you can't interfere, they add a third layer of steel to the trap: the waiver of notification. Buried deep in the fine print, you will almost always find clauses where you, the guarantor, waive your right to be notified about the status of the loan. You waive your right to be notified if a payment is late. You waive your right to be notified if the loan terms are changed. You waive your right to approve any modifications. You are essentially agreeing to be completely blindfolded. Your child could be missing payments for months, racking up thousands in penalties and driving the loan toward foreclosure. And the first time you might hear about it is when a certified letter from the bank's legal department arrives, demanding you pay the entire remaining balance of $300,000, plus fees, within 30 days. By then, the problem is no longer a small fire you could have helped put out. It's a raging inferno, and your entire financial house is about to burn down. This isn't a scare tactic. It is the standard operating procedure for guarantor agreements in the United States. The documents are intentionally written to give the lender maximum flexibility and minimum risk by transferring all of that risk directly onto you. So what's the savvy move? The first step is to recognize that the initial contract you are given is not a sacred text. It is an opening offer. Most people don't realize you can negotiate the terms of a guarantee. You can push back. You can cross out a clause and initial it. The bank might say no, but they might also say yes, especially if the primary borrower is a strong candidate who just needs a small boost. For example, you can counter with what's called a limited guarantee. Instead of guaranteeing the entire $400,000 loan for 30 years, you can offer to guarantee a specific amount, say the first $80,000, which covers the 20% down payment the bank is worried about. Or you could structure it as a burn-off guarantee, where your liability decreases over time. For every year your child makes their payments on time, your guaranteed amount drops by a certain percentage, until after 5 or 7 years, you're released from the obligation entirely. This transforms the guarantee from a lifelong financial ball and chain into a temporary support system, which is what most parents believe they are signing up for in the first place. Another, often much safer, alternative is the gift of equity, or simply a financial gift for the down payment. Instead of co-signing the loan, you provide the cash that allows your child to qualify on their own. Yes, this means giving away a lump sum of money, but it is a finite, known quantity. You give them $50,000. Your risk is capped at $50,000. Period. You are not exposing your entire life savings, your retirement accounts, and your own home to the unlimited liability of a 30-year mortgage. It's a clean transaction that empowers your child without indenturing you. The savvy parent understands the difference between giving their child a shield and chaining themselves to their child's financial fate. And knowing which questions to ask, which clauses to fight, and which alternatives to propose is the critical difference between being a helpful safety net and willingly stepping into a trap. So let's build the toolkit. Let's forge the armor a potential guarantor needs before ever walking into that bank. This isn't just about asking a few questions. It's about conducting a full-blown investigation, a financial deep dive where you are both the lead detective and the primary person of interest. Because the first person you need to be brutally honest with is yourself. The conversation starts not with the lender, not even with your child, but in the mirror. You need to ask yourself a series of uncomfortably direct questions. First, if my child loses their job the month after closing and can't make a single payment for a year, can I cover their full mortgage payment, principal, interest, taxes, and insurance, every single month without jeopardizing my own financial security? And I don't mean, could I scrape by? I mean, can I do it without liquidating my retirement accounts, without selling my own home, without compromising the life I've built? If the answer is anything other than an immediate, unequivocal yes, you are not in a position to be a full guarantor. Period. Second question for the mirror. How will this guarantee affect my own future plans? That dream of buying a vacation cabin, the plan to consolidate your own debt, or even the ability to co-sign a car loan for another child, all of it could be blocked. When you guarantee a loan, that entire debt, let's say it's a $400,000 mortgage, appears on your credit profile as a contingent liability. To a future lender, it looks like you already have another $400,000 loan. Your debt-to-income ratio gets blown out of the water. You become a bigger risk. So, are you willing to put your own financial mobility on hold, potentially for decades? And the third most difficult question: what is my emotional and relational exit strategy? If things go south, if payments are missed and you have to step in, how will that change your relationship with your child? Are you prepared to become their de facto landlord? Are you prepared for the resentment, the guilt, the blame? Money complicates family. A mortgage guarantee can detonate it. You have to game out the worst-case scenario, not just financially, but emotionally. Only after you've had that honest, gut-wrenching conversation with yourself can you move on to the next stage: interrogating the lender. You are not just a passive helper here. You are a party to a massive financial contract. You have the right to demand clarity. Your first question should be, is this an unlimited or a limited guarantee? An unlimited guarantee, which is the default for most banks, makes you responsible for 100% of the loan amount, plus any legal fees and penalties, for the entire life of the loan. It's the financial equivalent of a blank check. A limited guarantee, on the other hand, is your first and most powerful point of negotiation. You can ask to limit your exposure. For instance, you could say, I will guarantee the first 20% of the loan. This is often enough to satisfy the lender's risk requirement, because it covers the same amount as a down payment and potential foreclosure losses. Once the borrower has paid down the mortgage to a certain point, your obligation disappears. Another option is a time-based limit. I will guarantee this loan for the first 7 years. The logic here is that after 7 years, the borrower will have a proven track record of payments, Their income will likely have increased, and the property will have appreciated, making them a much safer bet on their own. Most people don't even know they can ask for this. They just sign what's put in front of them. Don't be most people. Next, you demand to know about the notification process. Ask the lender, what are the specific triggers for notifying me of a problem? You need a clause in the agreement that states you will be notified in writing the very first time a payment is late, not 90 days later when the loan is in full-blown default. This is called the right to notice. It must be paired with the right to cure. This gives you the legal right to make the missed payment on the borrower's behalf to bring the loan current, preventing it from ever hitting default status and protecting both your credit and your child's. Without these two clauses, you're flying blind, only finding out about the fire when the whole house is already engulfed in flames. Finally, you need to have the tough love meeting with the borrower, your son, your daughter, the person you're trying to help. This isn't about accusation. It's about collaboration and verification. Say, show me the budget. Not the theoretical one they showed the bank, but the real one. The one that includes car repairs, student loan payments, weekend trips, and saving for their own retirement. You need to see on paper that they have a realistic monthly surplus after all expenses are paid. If the mortgage payment would eat up 50 or 60% of their take-home pay, that's a 5-alarm fire. They can't afford the house, and your signature is just delaying the inevitable. You also need to ask them, what is your plan B and plan C? What happens if you get laid off? What happens if you have a major medical emergency? Do they have an emergency fund that can cover at least 3 to 6 months of total living expenses, including this new mortgage? If they don't have that cushion, then you, the guarantor, are their de facto emergency fund. You need to be aware of that and be comfortable with it. Now, what if after all this due diligence you decide a full guarantee is just too much risk? This is where understanding the alternatives becomes your superpower. You don't have to just say no and walk away. You can propose a different path. The cleanest and simplest alternative is a gift. Instead of co-signing, you can gift them money for a larger down payment. If a borrower can put down 20%, the need for a guarantor often vanishes entirely. This is a clean transaction. You give the money, sign a gift letter for the bank stating it's not a loan, and your involvement ends. There's no lingering liability, no threat to your credit score, no decades-long chain attached to your name. You may have to consider gift tax implications, but for most people, it falls well within the annual exclusion limits. It provides the help they need without the risk you can't afford. Another powerful alternative is a gift of equity. If you're selling a home to your child, you can sell it to them for less than its appraised value. For example, if your home is appraised at $500,000, you could sell it to them for $400,000. That instant $100,000 in equity acts as a massive down payment in the eyes of the lender. It dramatically lowers the loan-to-value ratio and can help your child qualify easily on their own. You can also explore becoming a co-borrower instead of just a guarantor or co-signer. Now, this is a nuanced difference but a critical one. A co-borrower, also known as a co-applicant, is on the title of the home. You are a part owner. This gives you more control and a direct stake in the asset. If things go wrong, you have a legal right to force a sale of the property to pay off the debt, an option a guarantor does not have. This can be a more secure position, but it also means you're more deeply entangled, with potential capital gains, tax implications, and complications for your own estate planning. It's a trade-off between more risk and more control. Ultimately, navigating the world of mortgage guarantees is about shifting your mindset. You are not just helping out. You are entering into a binding multi-$100,000 business partnership with your family member, with the bank as the senior partner. Thinking like a business person, demanding transparency, negotiating terms, and exploring all alternatives is not a sign of distrust. It is the ultimate sign of financial responsibility. It protects you, it protects the person you love, and it ensures that the dream of homeownership doesn't turn into a shared family nightmare. But even with the best laid plans and a perfectly negotiated contract, what happens when life throws a curveball? What are the precise legal mechanisms that kick into gear during a default? And how can you protect your own assets if the worst-case scenario becomes a reality? Let's imagine a scenario. Sarah, a young graphic designer, finally gets her dream home with her father, David, a retired teacher, as her guarantor. For 3 years, everything is perfect. The payments are on time, the garden is flourishing, and family dinners are a weekly tradition. Then the curveball. Sarah's firm undergoes a massive, unexpected downsizing. Her job, the one that made the mortgage possible, vanishes overnight. The first month, she covers the payment with her emergency savings. The second month, she scrapes it together by selling some equipment. By the third month, the well is dry. The first missed payment isn't a loud explosion. It's a quiet, terrifying click. It's the sound of a legal tripwire being snagged. For the lender, this is where a meticulously planned, automated process begins. It's not personal, it's procedural. After the grace period, typically 15 days, a late fee is assessed. A letter is sent out, polite but firm. But when that payment rolls into 30 days past due, the tone shifts. Sarah is now officially delinquent. Her credit score takes its first major hit. The phone calls begin. At 60 days past due, the letters become more severe, mentioning breach of contract and potential acceleration of the loan. At 90 days, the situation becomes critical. The lender sends a notice of intent to foreclose. This isn't a threat, it's a statement of fact. The legal gears are now grinding, moving inevitably toward taking possession of the home. But there's another parallel track running this entire time, one that directly involves David, the guarantor. When does the lender turn its gaze toward the guarantor? This is a critical misunderstanding for many. They don't wait until foreclosure is complete. They don't even wait for the 90-day mark. The moment the loan is in default, often as early as 30 days past due, the guarantee agreement David signed is activated. He receives a letter in the mail. It's called a demand letter. It doesn't ask for his help. It doesn't suggest he talk to Sarah. It formally notifies him that the primary borrower is in default, and that under the terms of the legally binding contract he signed, he is now responsible for making the payments. Immediately, the letter will state the amount past due, the late fees, and instruct him on how to pay. For David, reading this letter is a heart-stopping moment. The theoretical risk he signed up for 3 years ago has just materialized in his mailbox. It's no longer an if, it's a now. His first instinct might be to call the bank and say, "This is Sarah's loan, you need to work with her." But the bank's response is cold, hard, and backed by contract law. The guarantee he signed likely contained a clause called joint and several liability. This is one of the most important and most brutal legal concepts in finance. Let me break it down. Joint means that he and Sarah are in this together. Several means they are also in it separately. What this translates to in the real world is that the lender doesn't have to chase Sarah first. They can legally pursue the entire debt from either party. They will, without hesitation, go after the person with the most assets and the best ability to pay. Suddenly David, the retired teacher with a paid-off home and a healthy pension, becomes the primary target. He is not a backup plan, he is plan A. So what are his options? Refusing to pay is not one of them. Ignoring the demand letter is the financial equivalent of standing still on a railroad track. The lender will report the delinquency on David's credit report, just as they did for Sarah. His pristine credit score, built over a lifetime of responsible borrowing, will plummet. The damage is immediate and catastrophic. If he continues to refuse, the lender will sue him. Not Sarah, him. They will file a lawsuit for the outstanding amount, and because he signed a clear-cut guarantee, they will almost certainly win a judgment against him. With that judgment, they can pursue his assets. They can garnish his pension checks. They can levy his bank accounts, freezing them and taking the money right out. In some states, they can even place a lien on his own paid-off home, potentially forcing its sale to satisfy the debt. The financial guillotine he thought was hanging over his daughter's house is now hanging directly over his own. This is the nightmare scenario. So, how do you protect yourself? The most powerful protections are proactive, put in place before you ever sign. But what if you're already in this situation? What can David do now? The single most important action is immediate and open communication. The second Sarah knew she was in trouble, she should have called the lender, with David on the line. Lenders don't actually want to foreclose. It's an expensive, messy process. They want to get paid. They have options like forbearance, which temporarily pauses or reduces payments, or a loan modification, which can permanently change the terms of the loan, like extending the term or lowering the interest rate. Having the guarantor, the financially stable party, involved in these negotiations adds immense credibility. It shows the lender that there's a committed team working to solve the problem. The moment David receives that demand letter, his second call, after talking to Sarah, should be to a qualified real estate or debt attorney. He needs a professional to review the original guarantee agreement. Was it drafted correctly? Are there any consumer protection violations? Are there state-specific laws that offer him some defense? For example, Some states have one-action rules that may require the lender to foreclose on the property before they can sue the guarantor personally for the money. These nuances are impossible for a layperson to navigate, but for a lawyer, they can be powerful leverage in a negotiation. We also have to consider the nuclear option, bankruptcy. This is where the intertwined financial fates of the borrower and guarantor become truly terrifying. Let's say Sarah, overwhelmed with debt, files for Chapter 7 bankruptcy. The court could discharge her personal liability for the mortgage debt. For her, the debt is legally gone. But for David, it's the exact opposite. The bankruptcy court has just eliminated one of the responsible parties, which means the lender will now turn their full, undivided legal attention to the only person left on the hook, the guarantor. David is now 100% responsible for the entire remaining mortgage balance, with no recourse to the original borrower. It's a legal trapdoor that many guarantors have no idea exists until they've already fallen through it. Beyond the legal and financial devastation, we cannot ignore the emotional fallout. The relationship between Sarah and David is now under unimaginable strain. His retirement, which he worked 40 years to secure, is now being drained to pay for a house he doesn't live in. Every phone call is tense. The family dinners have stopped. There's guilt on her side, resentment on his. The act of love and support that started this journey has curdled into a source of profound stress and conflict, potentially fracturing the family in ways that money can never repair. This is the hidden, unwritten cost of a guarantee gone wrong. The contract doesn't just bind your assets, it binds your relationships. We've seen the catastrophic chain of events that a default can trigger. But this entire nightmare hinges on the words written in that original guarantee agreement. Most people sign the standard document the bank provides without a second thought. But what if you didn't have to? What if you could build a legal fortress into the agreement itself? What are the specific little-known clauses, from limitations on the amount and duration of the guarantee to non-negotiable notification rights, that can shield you from the worst of the fallout, and how do you get a bank to actually agree to them? Let's start with the most powerful and most fundamental protection you can negotiate: turning an unlimited guarantee into a limited one. The standard agreement a bank will slide across the table is almost always an unlimited and continuing guarantee. That phrase should send a chill down your spine. It means you are on the hook for 100% of the loan, plus any interest, late fees, legal costs, and collections fees the bank incurs. It means that if the borrower refinances, extends, or modifies the loan, your guarantee likely still applies. It is a blank check written on your entire financial future. You must refuse to sign this. Instead, you negotiate for a limited guarantee. This limitation can take two primary forms. The first is a principal amount limit, also known as a fixed cap guarantee. Instead of guaranteeing the full, say $400,000 mortgage, you negotiate to guarantee only a portion of it. For example, you might guarantee only the first $80,000. This is often structured as a top-up guarantee, covering the difference between what the buyer can afford and what the bank requires. The bank's primary risk is in the early years of the loan, before the borrower has built any equity. By guaranteeing that initial slice of risk, you are still providing immense value to the lender, but you've capped your absolute worst-case scenario. Instead of losing everything, you know your maximum exposure is $80,000. It's still a huge amount of money, but it's a knowable amount. It's a number you can plan around, not a bottomless pit. The second form is a time limit. Here, your guarantee is only active for a specific period, for instance, the first 5 or 7 years of the mortgage. The logic is the same. The bank's risk is highest at the beginning. After 5 years, the borrower has a proven track record of payments, the property has likely appreciated, and a portion of the principal has been paid down. The loan is less risky. At the end of the agreed-upon term, your guarantee simply evaporates. You are free. Combining these two, a principal limit for a set period of time, is the gold standard of guarantor protection. So how do you get a bank to agree? You don't make it a demand. You make it a business proposition. You explain that you are willing to help your family member secure the loan, but you cannot take on an open-ended, unlimited liability that would jeopardize your own retirement. You frame it as, I can provide a guarantee of $80,000 for the first 5 years, which covers your period of highest risk. Or I can provide no guarantee at all. Faced with a reasonable, limited guarantee versus no deal, many loan officers, especially at smaller banks or credit unions with more autonomy, will see the logic and work with you. Next, a clause that is absolutely non-negotiable: the right to notice of default. This is your early warning system. Without it, the The bank has no legal obligation to tell you if the borrower misses a payment. Think about that. Your child could miss one payment, then two, then six. All the while, late fees are compounding, interest on the arrears is piling up, and the loan is spiraling towards foreclosure. The bank might not call you until they are about to initiate legal proceedings. By then, a manageable problem of a few $1,000s has ballooned into a tens of thousands of dollars catastrophe. The right to notice of default clause legally obligates the lender to notify you, in writing within a specified time frame, say 15 to 30 days, of the very first delinquency. This is your lifeline. It allows you to intervene immediately. You can find out what's wrong. Is it a temporary job loss? A medical issue? It gives you the chance to talk to the borrower, maybe front them the money for a payment or two to get back on track, and work out a plan before the situation becomes unsalvageable. To a bank, you argue that this is in their best interest too. It enables you, the financially stable party, to help cure the default, saving the bank the enormous cost and headache of foreclosure. It's a simple clause that transforms you from a future victim into a proactive problem solver. The third set of clauses are your legal fallback weapons: the right of subrogation and the right of contribution. These sound complex, but they're critically important. The right of subrogation is your right to step into the bank's shoes. Let's say the worst happens. The borrower defaults, and you are forced to pay the bank $50,000 to settle your guarantee. Subrogation gives you the legal right to then pursue the borrower for that $50,000. Essentially, you inherit the bank's legal standing to collect the debt. Now, seeking repayment from your own family member is an emotionally devastating prospect we'll discuss later. But from a purely financial standpoint, you must preserve this right. Without it, the money you paid is legally considered a gift gone forever. The right of contribution applies if there are co-guarantors. For example, if you and a sibling both guarantee a parent's loan. This clause ensures that if the bank decides to come after only you for the full amount owed, you have the legal right to sue your sibling to force them to pay their fair share. It prevents one guarantor from being unfairly singled out and left holding the entire bag. Many standard agreements will actually ask you to waive these rights. You must strike that waiver. Finally, and this is one people almost always miss, is the material alteration clause. Imagine you guarantee that $400,000, 30-year loan. 5 years later, the borrower and the bank decide to refinance, tacking on another $50,000 in cash-out debt and extending the loan term. A standard guarantee could be interpreted to automatically apply to this new, larger, riskier loan, all without your knowledge or consent. Your liability just secretly increased. A material alteration clause prevents this. It explicitly states that if the core terms of the loan, the principal amount, the interest rate, the repayment schedule, are changed in any significant way, your guarantee is immediately terminated unless you provide new, explicit, written consent to the new terms. It protects you from guarantee creep, ensuring the deal you signed is the only deal you're on the hook for. Getting these clauses into the final agreement requires a proactive strategy. You cannot wait until closing day when a stack of papers is shoved in front of you. The moment you agree to be a guarantor, you must inform the borrower and the loan officer that your attorney will need to review and amend the guarantee document before you sign. This signals that you are an informed and serious party. Your lawyer will then draft an addendum or rider with these protections. The bank's legal department will review it. There may be some back and forth. They might push back on limiting the guarantee amount, but they are far less likely to fight on your right to receive notice or protections against material alterations, as these are seen as commercially reasonable. Remember your leverage. You are the key that makes the entire transaction possible. The bank wants the deal to close. You are not a supplicant asking for a favor. You are a crucial business partner defining the terms of your participation. By methodically building this fortress of clauses, you are not being difficult. You are being prudent. You are honoring the spirit of helping your loved one, while fiercely protecting the financial security you've spent a lifetime building. And that protection, that prudence, is the final and perhaps most crucial piece of the guarantor puzzle. Because once the ink is dry, the contract is signed, and the keys are in their hand, the journey isn't over. It has just begun. We've spent this entire time talking about the mechanics, the legalities, the pros and the cons, but now we need to talk about the one thing that will define this experience for years to come: the future. We need to game out the different timelines, the potential realities that can unfold from this single decision. First, let's imagine the best-case scenario. This is the outcome everyone hopes for, the reason you even consider doing this. In this reality, the borrower, your child, your friend, is a model of financial responsibility. Every payment is made on time without exception. They get a promotion at work. Their income rises. The property value in their neighborhood appreciates steadily. After 2, maybe 3 years of flawless payment history and a healthy increase in home equity, they refinance the loan. Your name is officially removed from the mortgage. The release clause we talked about is executed perfectly. You receive a letter from the lender confirming your obligation has ended. A massive weight is lifted from your shoulders. Your credit is untouched, your assets are secure, and most importantly, your relationship is not just intact. It's stronger than ever. You helped them achieve a dream they couldn't have reached without you. And they proved they were worthy of your trust. This is the win. This is the grand slam. But we have to be honest. Life is rarely that clean. So let's talk about the second scenario, the much more common one, the messy middle. In this reality, the borrower doesn't default. They don't lose the house. But they struggle. Maybe there's an unexpected job loss, a medical emergency, a divorce. Life happens. Suddenly, payments start coming in late. Just by a few days at first, then a week, then 2. As the guarantor, you might not even know at first. The first sign might be a small, inexplicable dip in your own credit score. You investigate and your heart sinks. You see a late payment reported on the mortgage you co-signed. Now the phone calls begin. They are awkward, stressful conversations filled with excuses and promises. I'm so sorry, it won't happen again. I just need to get back on my feet. You are now in a terrible position. You're not just a parent or a friend. You're a quasi-lender, a financial watchdog. Every conversation becomes tinged with the subject of money. You find yourself asking questions you never wanted to ask. Did you get paid this week? Is the mortgage covered? The stress bleeds into the relationship. Family dinners become tense. The borrower feels scrutinized and ashamed. You feel worried and resentful. Even if they eventually catch up on payments, and even if you're never asked to pay a dime, the damage is done. Your credit has taken hits, affecting your own ability to get a loan or a good interest rate. And the relationship has been fundamentally altered, strained by the weight of this shared financial burden. This messy middle is where relationships are tested to their breaking point. And that brings us to the third scenario, the one nobody wants to think about but everyone must. The worst-case scenario. In this reality, the struggle becomes a complete default. The borrower loses their job and can't find another one. The late payments turn into missed payments. 1 month becomes 2, then 3. The lender's polite reminder letters turn into formal notices of default. And those notices aren't just sent to the borrower. They're sent to you. Suddenly, you are legally and fully on the hook. The lender doesn't care about the borrower's sob story. Their contract is with you, the person with the good credit and the deep assets. They will demand that you start making the full monthly payments, principal, interest, taxes, and insurance. If you refuse or are unable to, they will begin foreclosure proceedings on the house, and simultaneously, they can initiate legal action against you to collect the debt. This means they can pursue your savings, your investments, even garnish your wages. The home you helped your loved one buy is now a catastrophic liability. You could be forced to liquidate your own retirement accounts to pay off a mortgage on a house you don't even live in. The financial devastation can be absolute, potentially wiping out a lifetime of savings. And the relational fallout? It's almost unimaginable. The trust is shattered. The relationship may be permanently destroyed, replaced by bitterness, blame, and profound regret. This isn't a scare tactic. It is the documented legal reality of what you are signing up for. You are agreeing to absorb a financial nuclear bomb if it ever detonates. So, standing at this crossroads with these 3 potential futures stretching out before you, how do you make the final call? It comes down to answering 4 non-negotiable questions with brutal honesty. First, the financial question. Can I truly afford the worst-case scenario? This isn't about whether you can help with a payment here or there. This is about looking at the total outstanding loan balance. Let's say it's $300,000, and asking yourself, if I had to pay this entire amount tomorrow, could I do it without losing my own home, without bankrupting my retirement, without destroying my own financial security? If the answer is anything other than an immediate, unequivocal yes, you cannot afford to be a guarantor. This is the ultimate sleep-at-night test. Second, the relational question. Is our relationship strong enough to survive the pressure cooker of financial entanglement? Have you ever had open, honest, difficult conversations about money with this person before? Or is it a topic you avoid? If you can't sit down right now and talk candidly about credit scores, debt, budgets, and worst-case scenarios without defensiveness or awkwardness, your relationship is not prepared for this. A mortgage guarantee is not the time to start learning how to have hard conversations. You need to have a black belt in financial communication before you even consider this. Third, the character question. Do I have absolute faith in this person's financial discipline and resilience? Notice I didn't say their income. Income can vanish overnight. I'm talking about their character. Are they the kind of person who lives below their means? Do they have an emergency fund? Do they delay gratification? Or are they someone who always seems to have a new car, a new phone, the latest gadgets, while complaining about being broke? Are they resilient? When they've been knocked down in the past, have they taken responsibility and fought their way back up? Or have they looked for bailouts? You are not betting on their job. You are betting on their character. And finally, the structural question. Is the agreement built for my protection? This goes back to everything we've discussed. Is there an ironclad guarantor agreement in place? Does it specify the exact conditions under which I will be contacted? And most critically, is there a clear, defined, and achievable exit strategy? Is there a guarantor release clause in the mortgage documents with the lender? If the lender doesn't offer one, you should seriously reconsider. Your goal is not to be on this loan for 30 years. Your goal is to be a temporary launchpad, not a permanent safety net. You need to know from day one exactly what the finish line looks like and how to get there. Ultimately, being a mortgage guarantor is one of the most profound acts of financial faith you can place in another human being. It's a gesture that says, I believe in you so much that I am willing to stake my own financial future on your success. But it cannot be a decision driven by emotion, guilt, or a desire to please. It must be a cold, calculated business decision. Think of it this way, you are not just helping someone buy a house. You are becoming a silent, non-equity partner in a 30-year, six-figure leveraged investment, and you are personally guaranteeing all of the downside risk. When you reframe it like that, the gravity of the situation becomes crystal clear. The desire to help your children, your family, your dearest friends get a foothold in life is a powerful and noble one. But true help isn't about enabling a dream at the potential cost of your own security. True help is about making wise, sustainable decisions that strengthen both parties in the long run. Sometimes that means providing the down payment as a gift instead. Sometimes it means helping them build a budget so they can qualify on their own in a year. And sometimes it means having the courage and the love to say no. If you've been on either side of this equation as a guarantor or as someone who needed one, I would love to hear your story in the comments. Your experience, your wisdom, could be the deciding factor for someone watching this right now, standing at that very same crossroads. Thank you for watching.